Good day, viewers. Today we are going to cover in this section business valuations. We will use question 6.33 on the financial management textbook by Carlos Correia. Let's go to the required. Employ the free cash flow model to value the ordinary equity of Biotech Limited as at January 20x3. How would your value change if the capital expenditure can be deferred until the FDA and other regulatory approval is obtained? Before we answer this question, we have to have assumed knowledge. Let me pause this video now and say, if you haven't downloaded this question, please go to the comment section under this video and download this question and print it, and then you start again so that at least you will be able to go through together in this session, as you'll be required to look into your question and also into this solution. Now, before we start reading the scenario, there is assumed knowledge that is required. The assumed knowledge is that you are now able to calculate the NPV and you are also able to discount the cash flows. You are also able to identify a perpetuity. There is a difference between a perpetuity and an annuity. Then you have also came across these two formulas on your cost of equity or cost of capital, and also on your dividend valuation. You will recall that KE is the cost of equity, PO is the share price, DO is the current dividend, and G is the growth. Now let's go to the scenario and read the scenario slowly and understand it. Biotech is a small South African biotech company which started operations 5 years ago and has so far expended 56 million on the development of the enzyme-based drug, which is expected to reduce and defer the debilitating effects of type 2 diabetes. In this sentence, we are told that the company has already spent 56 million. That 56 million is a sunk or a past cost. So it's not relevant when valuing this business, and it's also not relevant when calculating the NPV. Let's go. The potential for the drug is huge and it replaces and complements current oral therapies, and the new drug is expected to be eligible for about 10% of the current type 2 diabetes sufferers in South Africa and the world. So in this sentence, we are told that this drug will only be used by 10% of the total population of the people that are suffering from the drug, from diabetes. There are currently 140 sufferers of type 2 diabetes in the world, with half unaware that they have the disease. So if 140 million have the disease but half are unaware, so the ones that are aware that they are suffering from diabetes is 70 million. This means that the number of potential patients will amount to 10% of 70 million, and it is expected that this number will grow by 8% per year from the end of 20x3. As I said, the number of people who know that they have diabetes is 70 million, which is half of 140, but the ones that will use this drug is only 10%. But we are also told that this 70 million will increase by 8% per year from 20x3, which will be a growing perpetuity. The major market will be the USA, with Europe also being a major source of potential patients. The company is expected to achieve penetration rates of percentage of eligible or potential patients using the drug in each year. Rate of market penetration in 20x4, 20% of eligible patients will use this drug, 30% in 20x4, 5, and 45% in 20x6. The current drug under development is subject to the results of the phase 3 clinical trials and then requires FDA and other regulatory approvals. The probability of success in the clinical trials is 50%, and the subsequent probability of FDA under regulatory approval is 70%, which gives us a combined probability of 50% multiplied by 70%, which is 35%. The gross profit percentage is expected to be 80% of the sales price. If the gross profit is 80% of the sales price, then the cost of sales is 20% of the sales price. The company is expecting the annual patient's price to be $120. So this is the selling price of the drug to each patient per year, which is 120 rands. Although the company would be able to achieve double this rate in the USA, Europe, and Asia, the company is setting a relatively low price to enable the company to meet the challenge of expected new competing drugs in the future. The company is required to use a major pharmaceutical company to make the drug worldwide. Diabetes is an epidemic. 50 years ago, there were 30 million people worldwide who had diabetes, but this has grown to 177 million. It is expected that type 2 diabetes, adult onset diabetes, of which there are currently 140 million sufferers, will grow at a rate of 8% per year for the next 50 years from the end of 20x3. This rate of 8% we have already been given above. This is due to the aging of the population, sedentary lifestyles, and changing diets. In type 2 diabetes, people lose the balance between insulin and blood sugar. When the pancreas falters in the production of insulin, cells will not absorb the required amounts of glucose, resulting in a rise in blood sugar, which leads to other complications. Currently, other drugs will enhance the ability of the pancreas to produce insulin or to reduce the capacity of the liver to produce excess glucose. There are side effects such as weight gain and gastrointestinal problems. However, the sulfonylurea class of drugs are very cost-effective and are generic-based, but these types of drugs lose effectiveness for 45% of the patients within 6 years. Biotech Limited is developing an enzyme called inglukinase that is able to regulate both the secretion of insulin by the pancreas and the production of glucose by the liver. Currently, the drug is to be subjected to phase 3 clinical trials, and the results are expected within 6 months. This is followed by the FDA and other regulatory approval process, which will take a further 6 months. So that 6 months plus 6 months, it will be 1 year. So that if both are successful, then production and sales will commence from 20x4. Assume cash flows occur at the end of each year. The current date is 2 January 20x3. The drug is expected to reach a maximum penetration rate of 45% within 3 years and will remain at this rate for the indefinite future. Because of the development of the new drug, the price will be retained at the current levels, and growth will be driven only by the underlying growth in the number of type 2 diabetes patients, as the patients will be increasing by 8% per year. Although the normal life cycle of a drug is about 12 years, biotech expects that the drug will have an indefinite life, which is a perpetuity, due to the competitive pricing from the initial production phase. In order to market the new drug all over the world, the company will enter into a joint venture with Plax Pharmaceuticals Limited, a major pharmaceutical company with a worldwide distribution and marketing network, whereby Plax will acquire 50% of equity of biotech. The company is also managing the regulatory approval process. The marketing costs to be incurred will amount to 15% of sales, and general support and administrative costs are expected to be 50% of the marketing costs. However, in 20x4, to gain market acceptance, marketing costs will amount to 50% of sales revenue, and administrative costs will amount to 50% of marketing cost for that year only. From 20x7, marketing costs and administrative costs will not relate to sales revenue, and the expected amounts will be the 20x6 amounts, which are thereafter expected to increase at an annual rate of 4%. That's a growing perpetuity. Net working capital balances are expected to reflect the following ratios: accounts receivable 60 days sales, accounts payable 60 days cost of goods sold, inventory 90 days cost of goods sold. Operating cash is expected to be 1% of sales revenue. The company is required to spend 125 million at the beginning of 20x3 on advanced manufacturing and diagnostic equipment. This is our investment. The equipment is required to fast-track the approval process. No further capital expenditure will be required in the future years. The capital expenditure is 100% deductible in the year of acquisition. That's a strategic industrial allowance. The usual case is we'll be given the depreciation of this asset, then we'll calculate the tax saving on depreciation. But in this instance, the investment is allowed in full as a deduction. So it will be different, it will have a different treatment, and we'll see it shortly. And the research and development costs are also deductible in the year incurred. The company has a tax assessed loss of 52 million prior to the expenditure. The cost of capital for the biotech sector is expected to be 20%. This is our discount rate, or the weighted average cost of capital that will be used to discount the cash flows. Accounting depreciation and amortization is expected to be 15 million per year once the company commences production. We're going to use this figure to calculate tax saving or tax relief, but we are not going to, as the investment is deductible in full. The company expects to expend, which is to spend 10 million per year for the years 20x3 to 20x6 on research and development, and thereafter this annual amount is expected to increase at a rate of 4%. So from year 20x7 going forward, it will be a growing perpetuity. The development of the new drug has to be due to the efforts of Dr. Charles Parker and his research team, but no further drugs are expected to be developed in the longer term. The valuation of biotech will be used by Plugs Pharmaceuticals in order to decide on the price for 50% of the company. The corporate tax rate is 30%. Plugs will take on any currency risk, and the future cash flows of the company will not be affected by the currency movements. The current assets and liabilities of the company are immaterial until the company begins production, and you may assume that the investment in working capital will take place at the end of each year at the same time that the underlying sales and costs occur. The company has interest-bearing loans at the rate on the statement of financial position at the current date amounting to 45 million. Then we are back to the required. Employ the free cash flow model to value the ordinary equity of Biotech Limited as at 1 January 20x3. The second question is, how would your value change if the capital expenditure can be deferred until the FDA and other regulatory approval is obtained? So here we'll use the normal or the easy NPV that we are used to. Let's recap our assumed knowledge before we go to the solution. How to calculate the NPV and how to discount cash flows. How to identify a perpetuity. And we know these formulas and we have dealt with these formulas before. where KE is the cost of equity, PO is the share price, D is the current dividend, and G is the growth. We will use this formula, the second formula, for our growing perpetuity, where we will be substituting this DO for cash flows, whether it's cash inflows or cash outflows. We'll be using this second formula a lot. Now, let's go and prepare our solution. As I said, we should have downloaded this question on a PDF, on a Word document, printed it, then we go and listen to this video. So, if you haven't subscribed to my channel, pause the channel now and subscribe to my channel. Then now, let's go to the solution. I have gone ahead and prepared you for the heading so that at least we will save time. Now, we are told the total number of pensions for 20x3 will be 10% of 70 million. 10% multiplied by 70 million. 10% multiplied by 70 million. We get 7 million. Then we are also told that this total number will be increasing by 8%. So we will multiply that by 1.08. Then we can copy the formula to 20x7. So in this instance, we see that 20x3 will be our year 1, we'll see it shortly, and 20x4 will be our year 2, and so on. Now we are given the market penetration. We are told that in 20x4, the market penetration is 20%, 20x5, it will be 30%, 45%, then 20x7 going forward, it will also be 45%. Now, how many patients will be eligible or will use our drug in 20x4? We say total patients multiplied by our market penetration. We get that figure. We can copy the formula up to 20x7. Then we were given that each year, each patient will be paying 120 rands per year. Then our sales revenue per year, we say total eligible multiplied by the selling price, annual patient's price. We get that figure, we can copy the formula to year 5, which is 20x7. Then we are told that the gross profit percentage is expected to be 80% of the sales price. So if gross profit is 80%, then it means the cost of sales is 20%. So we multiply our sales revenue by 20%. Then we can copy the formula. Then our gross profit, then we will say sales minus cost of sales. We get our gross profit. We can copy the formula there. Then we say less expenses. Here we were told that the company is required to spend 125 million at the beginning of 20x3 on advanced manufacturing and diagnostic equipment. The equipment is also required to fast track the approval process. The capital expenditure is 100% deductible. So if it's 100% deductible, the expenditure that will be incurred will be 125 million at the beginning of 20x3. So at the beginning of 20x3, it should be 20x2, which is our year 0. Then we have to calculate now our marketing costs. We are told here that our marketing costs, the marketing costs to be incurred will amount to 15% of sales revenue, and general support and administrative costs are expected to be 50% of. However, in 20x4, to gain market acceptance, the marketing costs will be 50% of sales revenue. 50% of sales revenue. Then onwards, it will be 15%. It will be 15% of sales revenue. Then we are also told that from 20x7, the marketing costs will be 20x6 multiplied by 1.04, as the marketing cost will be growing by 4%. That's where in 20x7, that's where our growing perpetuity starts. Then we are also told that administrative costs will be 50%. So it will be marketing costs multiplied by 50%. You can drag the formula up to 20x6, but 20x7, it will be the marketing costs growing by 1.04. Then we have got our research and development. We are told that the company expects to expend 10 million per year from years 20x3 up to 20x6. Then from 20x7, it will be 20x6 multiplied by 1.04. That's where the growing perpetuity starts. Then from here, we can have our sum of total expenses. We can copy the formula there. We can also now have our net profit, which will be profit minus total expenses. And copy the formula there. Then we are told that at the beginning of the year, there is an assessed loss of 52 million. So we have to include it as opening. Then if we add with the net profit, we get the closing. Then we can copy the formula up to the end. Then in 20x3, the opening will be the closing for 20x1, 2. Then for 20x4, will be closing for 20x3. Then for 20x5, the closing is for 20x4. Then for 20x6, the closing is for 20x5. Then we do not take this closing as now it is a profit, not a loss. Then we start to tax the profit here in 20x6 at 30%. We get that figure. We also tax the 20x7. Then here, the cash flow before working capital will be our net profit minus our tax. Our net profit minus our tax. Our net profit minus our tax will be our cash flow before working capital. Then here, accounts receivables. We were told that accounts receivables is 60 days. So here, if you click here, there is 60 divided by 365 as a percentage is 16.4. Then accounts receivable are a percentage of sales, as we are told. So we'll say this percentage multiplied by our sales here. Now what we have to know is we now calculating working capital. Accounts receivable needs to be funded, so we'll put them as a minus there. Then we can copy the formula up to the end. Then accounts payable, now we'll be saying 60 divided by 365 is 16.4%. Then we multiply that by the cost of sales. Then we get that figure. Then accounts payable is a funding, so we'll have them as positive. Then we will also have our inventory, which is 90 days divided by 365 gives us 24.7%. So we say this one, again, it should be a negative multiplied by cost of sales. We get a negative as inventory needs funding. Then we are also told that operating cash is expected to be 1% of sales. So we'll say 1%. Cash also needs funding multiplied by our sales. Then we copy the formula there. Then we have our total working capital. We can copy the formula. Then we have our movement in 20x4. That's that. In 20x5, we'll say 20x5 minus 20x4. Then we can copy the formula there for the movement. Then now we have total cash flows. Now the total cash flows will be total cash flow before working capital plus working capital movement. Then we get our cash flows like that. Then we discount using 20%. So in year 0, the discount rate is 1. In year 1, the discount rate is 1 divided by 1.2. In year 2 is that divided by 1.2. Then in the following years, we can copy the formula there. Then we can calculate the PVs. The PVs will be saying 125 multiplied by 1. We get that figure. We can copy the formula there. Then now here, we will also only consider the sum of the cash inflows. So we'll start from year 1 up to year 5. We'll have that figure. Then after year 5, which is 20x7, the cash flows after 20x7 will be now a growing perpetuity. So the challenge here is the incomes are growing, the incomes and also the working capital are growing at 8%, but the expenses are growing at 4%. So we'll have to split them. So by splitting them, we'll have to get our profit figure here. Our profit figure is that. Then we'll have to have tax on that profit at 30%. we will also have our working capital movement. Working capital is not affected by tax. Then from there, we have to sum that. This figure now becomes our D0 because this figure is in 20x7. So it's in year 5, it becomes our D0. If now we want year 6, we will have to grow this figure by 8%, 1.08. We get that figure. Then now we have to divide by cost of equity minus growth. So now the cost of equity is 20, the growth is 8. So this figure will be divided by 12%, which is 0.12. We get our present value of cash inflows as that figure. Then now we come to our expenses. We have got marketing expenses, we have got admin expenses and research. Let's copy them where they are. In year 5, that's the figure. Then we can copy the formula down. It will drag those figures there. Then we can sum these ones. We get that figure. That figure, we have to apply tax there. Then we have to sum that. This figure that we get now is our D0. Then we have to grow this one, multiplied by 1.04. That's the growth rate. This now has to be divided by cost of equity minus growth, which is now 20 minus 4, which is 16%, divided by 0.16. We get the present value of the expenses as that one. Then now the total, we'll say this figure plus that figure. This is the present value of the perpetuity from year 6 until infinity. Now, when we discount year 6, from year 6 we get a present value in the previous year, which is year 5. So now we have to discount this value for 5 years so that at least we get the present value in year 0 terms. So the present value for year 5, we have it here as 4.02. We put it there. Then if we discount this, we say that multiplied by that. We get that figure. Then the total present value now will be this figure, the present value of a perpetuity, plus the present value of cash flows from year 1 to year 5, this one. Then we get 994,158,216. Then now we have to start to value our company now. We are told that the probability for success of the clinical trials is 50. The probability of success of FDA and other regulatory is 70. So the combined, we say 50 multiplied by 70, we get 35. Then now we have to multiply the present value by this probability. Why not multiplying the investment? Because the investment is in year 1, is not affected by probability because it will be incurred in year 0. So it will be incurred now, so there is no probability that will affect that one. We multiply by that, we get that figure. We less our investment, which is this one. We less the loan. We are told that the company has got a loan of 45 million. Why lessing the loan? Because we want the value of equity. We want the value of equity, not the value of the whole company. We want the value of the ordinary shareholders. So our value will be 177,955,376. Now, when delayed, This means when we delay to invest is to buy that equipment for 125 million. When we delay it until we get the clinical trials and the FDA, we will be delaying that by 1 year. So we have to discount our investment by 1 year, and also our investment will also be affected by now the probability. So the easier way, we will say the value that we have got, we will add back 125 million. Now we will less this 125 million discounted because now is now incurred in year 1. So we'll discount by 1 year, and also it will have to be affected by the what? It will have to be affected by the combined probability. So we'll say that figure multiplied by the combined probability divided, if it's in year 1, so it should be divided by 1.2 because the discount factor is 2. Then we get that figure. If we sum that, we will get the value of equity if the investment is delayed. Thank you very much, guys. If you practice this question time and again, it will become second nature. Do not forget to subscribe to my channel and share. Thank you very much.